Hello dear learners, welcome to Understanding Agricultural Finance. In this video, we will discuss the concept and significance of agricultural credit, credit needs of farmers and role of credit in agriculture. As you all know, that agriculture plays a very crucial role in Indian economy. According to the 2011 census data, in India, 54.6% of the population engaged in agriculture and allied activities. The number of agricultural cultivators and laborers grew from 234 million in 2001 to 263 million in 2011. India's agricultural sector is notably very vast. Although its contribution to GDP has declined over the past 30 years to approximately 15%, it remains a major employer, providing jobs to nearly half of the country's workforce. Additionally, the sector significantly influences GDP fluctuations. India possesses the world's second largest cultivable land area and is a leading producer of various agricultural products. Indian agriculture has witnessed a lot of ups and downs over the years. At a time of independence, Indian agriculture was in a state of acute food shortage. Today, India is a food sufficient country. Indian agriculture is characterized by low savings, low investment, and uncertain returns. Farmers' requirements of adequate capital is inevitable to increase the productivities of various resources used in farm production. With modernization, the agriculture sector in general has gradually become more competitive. Consequently, it requires a proper combination of money, management, and marketing for development of agriculture. Money as an important ingredient more often comes from credit and contributes in capital formation. Only small sections of farming community have their own capital to invest in agriculture. In fact, a major portion of the farming community needs capital to meet various expenditures both in the short run and the long run. Those farmers have to search for various sources which supplies farm credits. Also, majority of the farming communities in India are marginal and small, who cultivate their own consumption needs and have rather low marketable surpluses. For those farmers, proper farm finance policy is needed, as they are in need of more consumption credit and unable to offer security due to small size of holding. Farmers need credit support to have access to the resources on time as well as to maintain proper capital acquisition. However, care should be taken in utilizing the credit for productive purposes so that it become a lever for the development. Institutional credit support network is therefore extremely crucial in the interest of the farming community, with a timely monitoring mechanism to ensure an adequate financial flow to the agriculture sector. Agricultural finance is an important as other inputs in agriculture sector. It is important for agro-socio-economic development both at micro and macro levels. Agricultural finance plays a catalytic role in enhancing resources productivity and increase the farm income. Adoption of new and improved technology is imperative to augment agriculture as a business venture. We can call it as a supportive infrastructure setup. For instance, a combination of new potential seeds with other inputs like fertilizers, irrigation facility, plant protection measures, modern and improved post-harvesting techniques, market intelligence and connectivity, etc. Starting from sowing to post-harvest measures to marketing, every step in agribusiness needs adequate amount of capital to increase the productivity and efficiency. Proper framework of agricultural finance provides all necessary capital to create a strong resource backup at each and every step of farm business on timely basis, not only in supplying of quality inputs. Agricultural finance is equally important for farm output management. Large-scale financial investment activity entails assets and farm supportive infrastructure to increase farm income and overall improvement in the living standard of the farmer community. Agricultural finance can also contribute in minimizing regional imbalances and inter-farm variations between rich and poor. Importance of farm finance in both forward and backward linkages at micro and macro level is crucial and significant. Countries like India, where agriculture is still subsistence and stagnant in nature, agricultural finance is important to adopt new science and technology to speed up the overall development in farming. Moreover, massive investment is also necessary to carry out micro and macro level projects on irrigation, energy and electrification. Installation of chemical fertilizer plants, biogas plants, storage infrastructure, food processing plants, improved road and other connectivity, marketing infrastructure including efficient market intelligence network, execution of socio-economic development schemes and projects, etc. Hence, a good framework of agricultural finance is necessary for overall development in agriculture and to promote welfare in the society. A number of economists also believe that agricultural credit would emerge as the instrument of change for the Indian agriculture. Farmers might require credit for improving the agricultural production, repaying existing credit, and adopting improved methods of production. Now, let us discuss the importance of agricultural finance in India. Though agriculture play a crucial role in Indian economy, Indian farmers, especially small and marginal ones, often face financial constraints that limits their productivity and income. A strong framework for agricultural finance is crucial for the holistic development of the sector and the overall welfare of the society. So, we can summarize the importance of agricultural finance in India in the following points. So, number one, boosting farm productivity and modernization. With proper financial support, Indian farmers can invest in modern technologies like drip irrigation, mechanized farming, hybrid seeds, and use of artificial intelligence in agriculture, etc. Schemes like PM Kisan Samman Nidhi and submission of agricultural mechanization have been launched to facilitate such investment and improve farm productivity. The next importance is improve market access. Access to credit allows farmers to transport their product to large markets, potentially earning better prices and improving their bargaining powers. The next is mitigating risks from climate and market fluctuations. Indian agriculture is highly vulnerable to monsoon dependency, climate change, and market price fluctuation. A strong financial system that induces crop insurance, disaster relief fund, and price stabilization mechanisms can help mitigate these risks. The Pradhan Mantri Fasal Bima Yojana provides financial securities to farmers in case of crop failure due to natural calamities. However, the crop insurance is yet to be popularized in the country. The next is enhancing rural livelihood and employment. India has a large rural population that depends on agriculture for livelihood. A well-developed financial system can support agri-based industries, dairy farming, poultry and fisheries, creating additional employment opportunities and reducing migration to urban areas. The next importance is encouraging agri-entrepreneurship and startups. India has seen a rise in agri-tech startups that focuses on farm-to-market solutions, digital farming, and agri-processing. Financial incentives and venture capital support for such startup can enhance value addition, reduce post-harvest losses, and improve supply chain efficiency. The next is strengthening food security and export competitiveness. India is one of the world's largest producers of rice, wheat, pulses, and spices. A well-financed agricultural sector ensures food security by stabilizing domestic production and preventing price volatility. Additionally, financial support for export-oriented agriculture can help Indian farmers tap into global markets, thereby boosting agricultural exports. The next importance is ensuring financial inclusions for farmers. A majority of Indian farmers, particularly small holders, lack access to institutional credit and rely on informal moneylenders who charge exorbitant rate of interest. Strengthening agricultural finance through public sector banks, cooperative banks, microfinance institutions, and SHGs, that is self-help group, can provide farmers with affordable and timely credit. Let us discuss the credit needs of farmers. So we have discussed the importance of agricultural finance in Indian economy. So let us discuss the credit needs of the farmers. Farmers need finance for different purposes and to meet their varied needs. The classification of agricultural credit can be done as follows. On the basis of time period, we can classify the credit needs of farmers into short-term credit need, medium-term credit need, and long-term credit need. Now, what is short-term credit? So, when farmers need credit for less than 15 months for the purpose of cultivation or for meeting domestic expenses, they opt for short-term credit. Farmers are given this kind of credit for buying seeds, fertilizers, fodder for cattle, etc. They may also be given this kind of credit to support their families in those months when the crops are not adequate for this purpose. Such short-term loans are generally repaid after the harvest. The next is medium-term credit. Farmers may also require fund for medium term ranging between 15 months to 5 years for improving land, buying cattle, and agricultural instruments. Repayment period of such loans varies according to the period of loan. The next is long-term credit. When farmers need funds for long duration of time for buying additional land, improving existing land, paying off old debt, or purchasing costly agricultural machinery, they take long-term credit. The duration of such loan varies from 5 years to 20 years. Now, on the basis of purpose, we can classify the credit need of the farmers. Farmers may require credit for different purposes. Thus, you can further classify credit requirements of farmers into following purposes. So, number one is productive credit. This type of credit is taken by farmers for buying seeds, buying cattle, buying fertilizers, improving lands, and for running day-to-day activities in the agriculture field. This type of credit helps the farmers in their agricultural operations. Then there are some unproductive credit. Sometimes farmers take credit for meeting the family expenditures like marriage, birth, death, litigations, etc. This type of credit is known as unproductive credit, as it doesn't help the farmer in the agricultural operation. So in this video, we have discussed the concept and significance of agricultural credit, credit needs of farmers, and role of credit in agriculture. Thank you for watching this video. Thank you.
Agriculture is the backbone of the Indian economy. It plays a crucial role in our country's growth and development. A significant portion of our population depends on agriculture for their livelihood. Millions of farmers toil hard to provide food for our nation. Agriculture contributes significantly to India's gross domestic product, or GDP. It provides raw materials for various industries supporting industrial growth. The agricultural sector also generates employment opportunities in rural areas, reducing poverty and unemployment. Moreover, agriculture plays a vital role in ensuring food security for our vast population. A thriving agricultural sector is essential for our nation's self-sufficiency in food production. It reduces our reliance on imports and stabilizes food prices. India's agricultural journey has been remarkable. From a nation facing food shortages after independence, we have become self-sufficient in food production. This transformation is a testament to the hard work of our farmers and the advancements in agricultural technology. The Green Revolution in the 1960s played a pivotal role in boosting India's agricultural output. The introduction of high-yielding varieties of seeds, increased use of fertilizers, and improved irrigation facilities significantly increased crop production. However, Indian agriculture still faces challenges. Small landholdings, low productivity, and climate change pose significant threats. Farmers often struggle with low incomes, limited access to credit, and inadequate infrastructure. Access to finance is crucial for the growth and development of the agricultural sector. Farmers need capital for various purposes, including purchasing inputs like seeds, fertilizers, and pesticides. They also require funds to invest in modern technology, irrigation facilities, and farm machinery. However, many Indian farmers, especially small and marginal farmers, face significant challenges in accessing formal credit. Lack of collateral, limited financial literacy, and the perceived risk associated with agriculture make it difficult for them to secure loans from banks and other financial institutions. This is where agricultural finance plays a critical role. By providing timely and adequate credit to farmers, we can empower them to overcome financial constraints and invest in improving their productivity and income. Financial support can transform Indian agriculture by enabling farmers to adopt modern farming practices and technologies. With access to credit, farmers can invest in high-quality seeds, efficient irrigation systems like drip irrigation, and advanced machinery like tractors and harvesters. These modern technologies not only increase productivity, but also improve the quality of produce. For instance, drip irrigation helps conserve water and fertilizers, leading to higher yields and reduced input costs. Similarly, mechanization reduces labor costs and improves efficiency. Furthermore, financial assistance can also encourage farmers to diversify their income sources. They can invest in allied activities like dairy farming, poultry farming, and beekeeping, which can provide additional income and reduce their dependence on a single crop. Section 5. Weathering the storm. Mitigating risks in Indian agriculture. Indian agriculture is highly vulnerable to risks and uncertainties, primarily due to its dependence on the monsoon. Climate change is further exacerbating these risks, leading to unpredictable weather patterns, droughts, and floods. These risks can have devastating consequences for farmers, leading to crop failures, loss of income, and indebtedness. Therefore, it is crucial to have mechanisms in place to mitigate these risks and protect farmers from financial hardship. Crop insurance schemes, disaster relief funds, and weather-based index insurance are essential tools for managing risks in agriculture. These financial instruments provide a safety net for farmers, ensuring that they receive compensation in case of crop losses due to natural calamities. Section 6. Pillars of Support: Financial Institutions and Government Schemes. Various financial institutions and government schemes play a crucial role in providing financial support to the agricultural sector. Public sector banks, cooperative banks, regional rural banks, and microfinance institutions are important sources of credit for farmers. The Government of India has also launched several schemes to promote agricultural finance and enhance credit flow to the sector. The Kisan Credit Card, or KCC scheme for instance, provides farmers with timely and adequate credit for their agricultural needs. Other notable schemes include the Pradhan Mantri Fasal Bima Yojana, or PMFBI for crop insurance, the Pradhan Mantri Krishi Sinchai Yojana, or PMKSY for promoting efficient irrigation, and the Paramparagat Krishi Vikas Yojana, or PKVY for promoting organic farming. Section 7. Types of credit fueling growth in the fields. Agricultural credit can be classified into different types based on the duration of the loan and the purpose for which it is taken. Short-term credit, as the name suggests, is typically taken for a period of up to 15 months and is used for meeting expenses related to cultivation, such as purchasing inputs. Medium-term credit is taken for a period of 15 months to 5 years and is used for making moderate-term investments in agriculture, such as purchasing cattle, improving land, or buying farm machinery. Long-term credit, on the other hand, is taken for a period of more than 5 years and is used for making substantial investments, such as buying land or expensive machinery. Understanding the different types of agricultural credit is crucial for farmers to make informed decisions about their financing needs and choose the most appropriate loan product for their specific requirements. Section 8. Empowering farmers. Financial inclusion and access to credit. Financial inclusion is critical for ensuring that all farmers, especially small and marginal farmers, have access to formal financial services, including credit, savings, and insurance. Despite the progress made in recent years, a significant portion of Indian farmers still remain outside the ambit of formal finance. Promoting financial literacy among farmers is essential for increasing their awareness of financial products and services. It empowers them to make informed decisions about borrowing, saving, and managing their finances effectively. Technology can play a transformative role in enhancing financial inclusion in agriculture. Mobile banking, digital wallets, and online platforms can make it easier for farmers to access financial services remotely, reducing their dependence on traditional brick-and-mortar branches. Section 9. A bountiful future agricultural finance for a prosperous India. A robust and inclusive agricultural finance system is crucial for unlocking the full potential of Indian agriculture and ensuring the well-being of our farmers. By providing timely and adequate credit, we can empower farmers to invest in modern technologies, improve their productivity, and enhance their incomes. Furthermore, a well-developed agricultural finance sector can contribute to the overall growth and development of the rural economy. It can create employment opportunities, reduce poverty, and bridge the gap between rural and urban areas. By strengthening agricultural finance, we can pave the way for a more prosperous and equitable India, where our farmers are empowered to thrive and contribute to the nation's growth story.